Alright guys, in this video I will try to explain to you what is EBITDA, which is a term that gets thrown around very frequently by investors and venture capitalists with regards to your business. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So first let's talk about earnings. In a given period of time, you have an income for that period of time and you have expenses for that period of time. Your earnings are what is left over after you have taken into account your income minus your expenses. So these earnings are also called net income. Now, what are the different types of expenses you might have? You can have expenses related to the cost of goods sold. You can have expenses that are your financing activity related expenses, like if you took out a loan, you have to pay interest on the loan. You can have operational expenses, which are related to salaries and supplies and office spaces, labor, etc. And you can have government related expenses like taxes, franchise costs, and so forth. And then you will have expense such as depreciation on your supplies or equipment. For example, you have a tractor which is losing value each period, and so that loss of value each period is the depreciation on that tractor. So in this way, depreciation, amortization, taxes, interest, these are all expenses. However, they're not expenses related to your operations. Specifically, income and taxes are not related to your operations. And depreciation and amortization are related to your operations, but they're not actual cash expenses. They're expenses that are kind of virtual in some sense. The cash goes out up front and then eventually the item burns out, but in order to balance it out, you kind of take that and break it up into periods and say, I'm spending this much this period and this much that period. And so that's why depreciation and amortization are kind of broken up, whether you're recognizing revenue or you are depreciating an item. So this video is not about how depreciation and amortization work, so let's get back to EBITDA. But the key point to remember about depreciation and amortization is that the two of them are non-cash expenses, and the key thing to remember about interest and taxes are they are non-operational expenses. And so in order to understand what part of your income minus expenses are due to your operations, how much revenue are you bringing in, and then how much is going out in terms of supplies and labor and office and all of those kind of things, that number is basically EBITDA, because it's your earnings before interest, taxes, depreciation, and amortization. So the way you would do that is you would take your revenue, you would subtract your cost of goods sold, COGS, you would subtract out your operational expenses, and that would leave you with EBITDA. If you then further subtracted your interest, taxes, depreciation, amortization, you will get the final number, which is your net income. So that's it about EBITDA, and I hope you understand why it's important and why people always ask about it. Because if you're a venture capitalist or an investor putting money into the business, you're not as interested in the interest part of the business. You're interested in the operational part of the business and the costs of doing that.